In every cycle, crypto education focuses on buying. Buy the dip, buy early, buy conviction. Almost no one prepares investors for the harder decision, selling when prices are rising. By February 2026, market participation is higher than ever, yet the same emotional patterns continue repeating. Welcome to the Crypto IQ. Today we're discussing the psychology of selling, why taking profits feels irrational during bull markets, how euphoria distorts judgment, and what historical cycles show about where disciplined participants exited positions. Every major cycle has included a euphoria phase. This phase is not defined by a specific price. It is defined by behavior. In 2017, retail participation surged near the cycle peak. Search trends, exchange sign-ups, and mainstream media coverage all accelerated rapidly in the final months. In 2021, similar patterns appeared. Influencer-driven narratives intensified, leverage increased, risk tolerance expanded across all asset classes. In late 2025, comparable signals emerged again. Trading volumes spiked during parabolic moves. Long-term holders reduced balances, while short-term traders increased activity. Funding rates across derivatives markets remained elevated for extended periods. Euphoria often feels logical in the moment. Gains validate belief. Confirmation bias increases. The fear shifts from losing money to missing further upside. This is where most investors stop thinking about risk. Selling during strength triggers psychological resistance. When prices rise, the mind anchors to future projections rather than current valuation. Unrealized gains feel like momentum rather than exposure. There is also social pressure. During peaks, communities reward conviction and criticize caution. Selling appears disloyal to the narrative. Holding appears brave. Historically, however, major drawdowns followed peak enthusiasm. In 2018 and 2022, retracements erased large portions of prior gains within months. The difficulty is not understanding this pattern. The difficulty is acting before it repeats. Historical charts show that long-term holders gradually distributed into strength rather than selling at exact tops. On-chain data from prior cycles indicates that older coins moved more frequently during late-stage rallies. In 2017, distribution began months before the final high. In 2021, similar patterns emerged during the final upward acceleration. In 2025, wallet data again reflected gradual selling from large holders during extended price expansion. The common pattern is gradual reduction, not perfect timing. Dollar cost averaging out is the mirror of dollar cost averaging in. Instead of trying to predict the top, investors predefine exit intervals. For example, selling a fixed percentage of holdings every time price reaches specific milestones. This removes emotional decision-making from the equation. The strategy does not require forecasting. It requires structure. DCA-out accomplishes two goals. It locks in gains gradually. It reduces regret if price continues rising after partial sales. No one consistently sells the exact peak. Structured exits outperform emotional reactions. As of February 2026, markets are again debating cycle positioning. Some argue further expansion is ahead. Others warn of overheating conditions. The correct approach is not prediction. It is preparation. Profit-taking should be planned before euphoria intensifies. When sentiment peaks, discipline is weakest. Buying is easy when prices are low. Selling is hardest when prices are high. History shows that cycles end in confidence, not fear. smart participants reduce exposure gradually. Retail participants wait for confirmation that never arrives. You do not regret profits taken. You regret profits that disappeared. In 2026, the investors who preserve gains are not the ones predicting tops. They are the ones who planned exits in advance. Subscribe to the Crypto IQ, as we will come back again with another interesting topic.